ZCommunity cuties. What's poppin'? It's your boy Azizz Finance, and today we're gonna be talking about all of the different types of investments out there that you can pick. So some of the points that we're gonna be talking about today are: what is the difference between an investment and an investment strategy? All the different types of investments that you can make, along with their expected average returns, along with ranking each one of these investments as to which one is the best, and which one is not so good. Now keep in mind, this is an introductory video, so if you do want me to touch up on any of these types of investments, shoot me a message in the comments below or shoot me a DM on Instagram with the handle that you see on the screen right now. But without further ado, let's get this party started. Alright, so when it comes down to the difference between an investment and an investment strategy, I really like to use the analogy of a road trip. The investment is the vehicle that you choose to drive. Are you going to end up picking the Honda Civic, the Mercedes-Benz, or the classic Volkswagen Jetta? And when it comes down to the investment strategy, this is the route that you're going to take. Are you going to take the 427, or are you going to be taking the QEW or the 401? That's what your investment strategy is. Now, considering this analogy, there's a bunch of different cars that you can pick from, along with a bunch of different routes that you can take in order to get to your final destination, which I'm assuming is financial freedom or financial independence. Now, let's look at each and every single type of investment one by one. Now, our beautiful and most talked about investment within our channel are stocks. Now, as I've mentioned many times on this channel, now when it comes down to stocks, these bad boys can give you an average of 10% on a yearly basis, depending on how long you really hold them for. Then next up, we have bonds, which are investments within debt. Now, these bad boys can give you an average of 5.5% on a yearly basis, depending on how long you're gonna hold them for. Now, keep in mind, there are actually different types of bonds out there. Bonds, bills, debentures, James Bond, and notes. Yeah, I don't think you caught that either, because I just said James Bond. That could be a type of bond, actually. That could be a type of bond, but not the type of investment bond that we're talking about here. Now, what makes it really interesting about bonds is that the fact that they're investments in literal debt. I think the simplest way to actually break down how bonds usually work is by looking at a credit card with their high-ass interest of 19.99%, right? Now let's just say it's a situation where somebody is going to borrow $500 on their credit card at a 20%, let's just say rounding it up, at a 20% interest rate. Now, let's just say that the bank was super broke at the time, so what did they end up doing? They're like, yo, like, my dude, can you give us $500? We're loaning it out, but we don't have the cash for it. So you're like, okay, but what's in it for me? They'll be like, look, we're charging him a 20% interest. If he's not able to kind of pay it off on time, then we'll give you interest payments. We'll split that up. We'll split up the interest payments. So us as the bank, we'll keep, let's just say 15%, and we'll give you 5% because you lent us this money. So you think it's a great idea, so you're like, yo, let's shake on it. Now, that was just a really simplified example of what bonds are overall, but the main premise of them is that you can collect interest as a form of income. And usually, depending on the type of bond that you're going to go for, these can be either really risky, really conservative, or right in between. Now, keep in mind that the biggest difference between all these types of bonds that I just broke down for you guys is really two things: the time where your actual investment is within the bond, along with the actual value you buy these bonds at. Now, for bills, these types of bonds, you can actually potentially buy them at a discount, whereas with all the other types of bonds, you usually have to pay the price of what it's at right now. No discounts, and you're not overpaying either. Now, in terms of time frames, when it comes down to bills, these are usually investments where you'll have to hold your money for anywhere between a year to 2 years, or anything in between or less. Notes, on the other hand, are usually when you have your capital locked in for anywhere between 2 to 10 years. And then when it comes down to bonds, which, believe it or not, are a type of bond within itself, usually these guys can range anywhere from 10 to 30 years, meaning that your capital would have to be locked into there for that long. Then last but not least, we have debentures, which are bonds that are specific to corporate debt. So in this type of situation, you're giving out money as an investment to a specific company so that they can end up using it to grow their business, establish themselves, expand, whatever the case is. But when it comes down to corporate debt, there is the bad side of it and the extremely risky side, because there is a potential for these companies to default on these debentures, which can put you in a very sticky situation. If this is something that you want to potentially look into because the risk to reward ratio might be potentially high, you then want to look into the Standard & Poor's Moody list rating or something along those lines, where each and every single type of debenture or corporate debt is actually ranked on a scale, where I think it's like AAA is the highest, meaning that these guys have a very low risk of defaulting, and I think it goes down to the lowest, one of the lowest letters is like D or some shit like that, but essentially that's like the riskiest. Like these guys have the highest risk of defaulting on a loan, which can give you more interest, but it is a very risky situation to be put in. The next type of investment that we have are options, the second most talked about thing on this entire channel. And usually when it comes down to average returns on this bad boy, I would like to say a conservative 2% per month, and if you really want to push it, 4% per month. But this is really if you know exactly what you're doing, and obviously it depends on whether you're day trading, swing trading, or you're doing leaps. Now these types of investments are actually pretty interesting because they're like the stock market, but for actual tangible goods. I'm not even joking, like you could literally invest in barrels of oil, like stalks of corn, and even cows, believe it or not. Yeah, cows, those things that go moo moo on the farms. Now the most interesting part about futures is that whenever you're buying a futures contract, you're basically buying that certain commodity at today's price regardless of what it's going to be in the future. The easiest way to explain this is you going down to the gas station, you go talk to your dude, let's just say you're doing prepaid in this situation, you go up to him, you're like, boss, listen, let's make a deal, I will fill up my gas from here full tank, but each and every single time I do this, it's gotta be $60. Let's do this for the next 2 years, let's sign the deal. That's basically what a futures contract is. And where it comes in as an investment is, let's just say that, you know, a barrel or a gallon of oil ends up increasing in value over those next 2 years. Well, then you can come along with your futures contract, end up selling it at that higher price, and that's the profit that you end up making off of this futures contract. Pretty darn interesting, isn't it? Now when it comes down to futures, it really depends on what type of commodity you're investing in, but the overall average is usually around 7% per year. Then when it comes down to real estate, you should be expecting similar returns of 7% per year on average. But again, this comes down to so many different factors, like where's the property located? What exact strategy are you going to be using? Are you going to be having tenants? Is this just a flip? There's so many things that come down to it, but ultimately that golden average, 7% per year. Then after that, we've got precious metals. So, you know, gold, silver, all of those bad boys. These bad boys can actually give you up to 10% per year on average, or at least that's what it is for gold. For silver and other types of precious metals, this could vary as well. Then we've got GICs, CDs, or savings accounts. Now, ultimately, no disrespect, no slander, but these guys can only give you a maximum of 2% per year. That is if you're lucky. Most of the time, these things can range from 0% to literally 1%, but not really an investment in my eyes. I feel like it's just more like just put in your emergency fund and just kind of hope for the best type of thing. Then we've got mutual funds. I know you were probably thinking, wait, this guy's talked about all these types of investments, but where do mutual funds come in? This is where they come in. Now keep in mind, mutual funds, when we talk about them, we're talking about the umbrella term, which includes index funds, ETFs, fixed income funds, and all of that different stuff. Now, ultimately, the expected return on these types of mutual funds is going to depend again on the strategy, what's going to make up these mutual funds, and so on. But ultimately, these things can usually return you anywhere from 5% to 7% again, depending on those other factors. And last but not least, annuities. Now, believe it or not, this is the first time I've ever heard of this thing before, and it'll make sense once I break this down. But these annuities can give you about 3% per year, so just a little bit over that, you know, CD or GIC or high interest savings account types of returns, but it is still a very interesting concept. Now, the way that you can look at annuities is, think of it as a GIC or a high interest savings account, but rather than being with a bank, it's actually with an insurance company. And in return, the insurance company would end up giving you monthly income. Pretty weird, right? I just found out about this recently too. But honestly, just because of the low returns, I didn't do too much research into it, but it is something that I plan to look into at one point. So if you guys want me to touch up on that, let your boy know in the comment section down below. So ultimately, when it comes down to what type of investment should I go into, what is the best type of investment? What is the best type of returns? Ultimately, it depends on what you want to do, right? But if we had to rank these down from like the highest returns to the lowest returns, we would definitely have to put stocks at number 1. Real estate, futures, commodities, along with mutual funds, all tied at second place. Then followed by bonds, annuities, options, and then we have GICs, high interest savings accounts, and things of the like. And the last ranked investment, no investment at all. So yeah, ZCommunity, that's pretty much it. Let me know in the comment section down below which one of these investments that you've already tried or something that you want to dabble in a little bit more. And let's see if I can help you guys out. But without further ado, thank you guys for watching. It's your boy Azizz signing out. Peace.